Hello, I'm Donald Leggett. Welcome to the latest London Southeast CEO interview. I'm joined by Will Rhind, founder and CEO of US ETF provider GraniteShares. Granite have $1.5 billion of assets under management, and in the UK, Granite specialise in long and short ETPs. Welcome, Will. It's very good to see you from New York again.
Thank you, Donald. Thank you for having me back. Good to see you too.
Great. So how's the lockdown been treating you then, Will?
You know, so far I can't really complain too much, to be honest with you. You might be kind of surprised to hear that in a city like New York, things are remarkably normal, whatever that means these days. But we're able to go out to restaurants, to bars. We're able to work in an office, as some of you will notice. I'm in today, so things are kind of pretty normal, to be honest with you.
Good Lord, I think we're very envious of you, to be fair, Will. But hey, let's talk Granite. And in the UK, Granite specialise in innovative ETPs. So let me start by asking, what are ETPs? Why are they a useful tool for any experienced investor?
Well, ETP stands for Exchange Traded Product. And in many ways, they're interchangeable with their cousins or sisters, ETFs or Exchange Traded Funds. The big difference between the two is that ETPs allow you to do things that ETFs can't do. So, for example, whether that's single stock exposure or leveraged single stocks that we have, or whether it's targeted indexes or targeted baskets, they just allow you a bit more flexibility in terms of being able to deliver a product that you can't get with an ETF structure.
Great. Okay, good answer. I understood that. Granite already have 40 or so ETPs. So why have you launched these indices, as you call them, bundles of giant US tech stocks? Tell us all.
Yeah, well, this is the next step for us as a business. So those of you that are familiar with us will understand that we have a huge platform of short and leveraged single stocks. And that was a new category in the ETP industry. But the natural extension to that, of course, is providing exposure to indices or baskets of stocks. And we have launched our FAANG suite, as we call it, but they're very targeted pure play baskets to these largest tech mega companies in the world. And the reason for doing that is very simple. You can't get this exposure through an ETF. There is no pure play way to invest in the FAANG stocks. These companies that are becoming so important to the global economy. So by providing that through an ETP, it's a world first for us and for investors in terms of being able to access these baskets in ETP form.
So you said it there. These companies are becoming so important to the world economy. Today's Financial Times headline, I looked at this and I went, oh my goodness, this is one for Will. The combined revenues of Alphabet, Amazon, Apple, Facebook, and Microsoft jumped 41% in the first quarter. That is a stunning performance from people I was thinking were on the top of what has been an exceedingly long bull run. But look, they've just utterly done it again. These companies are so large and successful, you can't ignore them. So where do your FAANGs, GAFAMs, and FATANGs, where do your indices, where do your baskets, where do they fit into all this?
Well, it's a great question because I think there's a school of thought that says these companies are not part of the market. They are the market. And if you look at what's happened in the US stock market, take 2020 obviously as an example. Those of you that are familiar with the major indices will know that the S&P finished up in 2020 despite the chaos that we endured in the pandemic. But most people won't realize that the reason for that is because these companies are representing about 25% of the index in the US stock market. Put it another way, Donald, if you had just invested in those 5 companies in FAANG, you would have outperformed the market by about 50% last year. So it makes a huge difference whether you're invested in these companies or not. And so from that perspective, why have exposure to all the other ones? Why not just pick, so to speak, the winners and exclude the losers? And that's what FAANG does.
Okay, and you've got three different baskets, 3 different bundles. So why don't we take the first one, FAANG? Let's break that down and explain to me what's actually in there.
Yeah, so FAANG, arguably, this is the original one that was supposedly coined by Jim Cramer of CNBC fame, talking about the acronym stands for Facebook, Apple, Amazon, Netflix, and Google. Obviously, Alphabet is the holding company stock, but that's Google in there. And then the other two baskets are different sort of permutations of that theme. So whether you include Microsoft in that mix, and that's what GAFAM is, or whether you include the latest and greatest darling for a lot of investors, Tesla, and that's FATANG. And so depending on your interpretation or your version of what these tech mega cap, the perfect basket of tech mega cap companies, that's what the three different acronyms stand for. So it's FAANG, GAFAM, or FATANG. Great.
Now, how do your ETPs work? Presumably these indices, your tech indices, work just the same as the others. Do you buy a piece of a share? Because I noted today that an Amazon share, one single share costs $3,590. My goodness, what a mighty share price. So where can I find out about how these things work? Where do I find out about costs, getting started, all the rudimentaries?
Well, I think the best place to go is to go to our website, GraniteShares.com. On the product pages for each of these products, you'll find out about all the key details. I think, some highlights to point out is there's two versions. So we do an unleveraged version, which as it sounds, just gives you exposure to the underlying index, long and short on an unleveraged basis. And then we do a 3 times leveraged version. So 3 times leverage the upside and 3 times leverage the downside. And so the way that they work, or the underlying index, they're equally weighted. That's an important thing for people to understand. They're equally weighted and they're rebalanced on a quarterly basis. And the share price for those particular products is significantly lower than you'll find the share price for Amazon that you just correctly mentioned. So you can buy exposure in a single ticker or a single trade to 5 stocks for a significantly less price than you would pay if you were to buy those individual stocks themselves.
So what's the minimum amount of money that I'd need to put into one of these baskets?
Yeah,
how much do I need to start trading?
If you took FAANG, for example, that's $5 a share at the moment. And there's obviously the share price moves every day, obviously, but roughly $5.
So quite accessible.
Oh, absolutely. Just like most, index-based ETFs, you're providing exposure to a basket of stocks, but at a price that's very reasonable, especially given, specifically for these stocks where some of them trade on an individual basis.
Okay, an obvious question, but nevertheless a useful one. What are the advantages of going short, going long, and using leverage?
Well, I think you mentioned the first one just there, which is getting access to the basket at a price, a very reasonable price, as opposed to buying the individual stocks themselves. I think the other thing is the package in terms of being able to get exposure to these names on a pure play basis in a single ticker without having to buy the stocks yourselves, incurring multiple ticket charges or commissions and then rebalancing. But of course, the main thing is just the exposure itself. If you pure play to the upside of these companies, or if you're bearish and you think that this is a bubble, just like 99, you're able to take the opposite side of that by going short, either on an unleveraged basis or on a leveraged basis. So the options for investors are really, how much conviction do you have in these particular indices? And there's enough conviction if you're bullish to go unleveraged, or 3 times leveraged if you're incredibly bullish. And the opposite is true as well. If you think it's all a bubble, you can go short.
And why not just hold these stocks individually for yourself, Will?
Well, I think, as I said, I think the two things for me is that number one, the stocks are incredibly expensive on an individual basis. And so by buying the ETP, you get access at a much lower cost. Secondly, a lot of people just don't want the hassle of buying individual stocks themselves and then rebalancing with a discipline. So in this case, we hold them equally weighted. It's actually reasonably difficult discipline to actually rebalance, on a quarterly basis. And so we manage all of that in one ticker. And for people, the majority of people, they just want that single ticker exposure and have the product do the work for them.
Okay, we're coming to the end of the interview, Will. So probably a good point to ask you about risk. How much risk is involved in these products? Can you lose all your investment? And how have Granite ameliorated that risk?
Well, I think with any investing, there's always risk, of course. I think in terms of the unleveraged products, I suppose theoretically, there's always a risk you could lose all of your money. However, for all of these companies to go bankrupt would seem remote, or would seem unlikely, to say the least. So I think there's clearly risk in investing in any stocks, but certainly the risk of complete loss would seem to be small. There is leverage risk when you're talking about leverage products. That is something that's a lot more risky than obviously on an unleveraged basis, because you're magnifying your exposure to the underlying market. So on the short side or the long side, that is certainly something that is more risky. I certainly would advise anybody that's looking at the leverage side to not get involved in any of these products until you understand how leverage works before you do it.
Okay, good advice. We didn't particularly ask you this before. We've met before. We've talked online before. Finally, who are GraniteShares? Talk me through your background. Explain all.
Yeah, so GraniteShares is a company that I started just over 4 years ago. I've been in the ETF industry all my career, originally from the UK, from Scotland more specifically. Now based in New York, where I've been for the last 11 years. But I set up GraniteShares really as a vehicle to offer what I think is answering the zeitgeist of today, which is providing products for the active investor, providing products for high conviction investments for the retail active trader of today. And specifically, what we're trying to do is fill that gap in the market where you have huge amount of interest in stocks and investing. You have retail, new neo brokers such as Robinhood here in the States, trading 2-on-2 people in UK, Europe, and a lot of investors that are interested in stocks. Now, the next step for that is what do they do after individual stocks? And we're trying to fill that gap in the market for providing high conviction investments to the latest either themes or parts of societal technology shifts, such as FAANG.
And how many retail investors are there trading in America at the moment? Would you roughly estimate?
Oh, to be honest, I have no idea. But I know that some of these brokers are taking on record numbers of customers. And indeed, last year, I think all the major brokers, not just Robinhood, which tends to get most of the media spotlight, but most of the big brokers reported record numbers of new customers signing on. So I think people very much are engaged in this market. I think the other thing, Donald, is that we don't often talk about this, but think about your alternatives. Back in the UK, when I was growing up, people said to me, okay, the first thing you've got to do as an investor is you have to get yourself on the property ladder. And when you accumulate enough money in savings, you buy property. And obviously the other side of it is, you get a good job and you retire on a company pension and that's you sorted. But really those two things don't exist anymore. In terms of getting on the property ladder, that's out of sight for the majority of people in their 20s. And in terms of long-term company pensions, they don't really exist anymore. So what's your alternative to doing, to saving, to building investments? The stock market is the answer. And that's increasingly what people are doing. And that's very much the zeitgeist here in the States. And I think from everything I see in the UK, that's happening as well, where people are starting to engage a lot more in the market because it's one of the only ways they can build wealth.
Well, Ryan, that makes an awful lot of sense, I have to say. Sadly, I'm going to have to end it there. Thank you so much for joining us from New York today.
Thank you so much.
It's been a real pleasure. If you're interested in these GraniteShares, these ETPs we've been talking about, www.granite, that's GRANITE shares.com. That's the website. And my final thought, please do keep staying safe in these difficult times.